Different companies have different capital structure. Capital structure is referred to the amount of debt and equity employed by a firm to fund its business operation and to finance its asset. The structure is typically expressed as a debt-to-debt equity ratio or debt-to-capital ratio. Debt and equity capital are used to fund its business operation, capital expenditure, acquisition, and other investment. From the M&M theory, capital structure have two propositions. Firstly, capital structure with a combination debt and equity will not affect the value of the company. This is because capital structure do not influence any value of the company as it does not have any cash flow changes in the company. So that if the cash flow of the company is changed, so that the value of the company also change. Secondly, M&M proposition also depends on three things. Firstly, required rate of return. Secondly, cost of debt. And thirdly, debt or equity ratio. If required rate of return of equity is increasing, so that the company's debt equity also increasing.
Next, I will explain about optimal capital structure. Optimal capital structure is a combination between the debt and equity. The right combination of these two is when the company can maximize the market value and minimize the cost of capital of the firm. A company that have higher debt can reduce the tax, but be remember it also can increase the financial risk of the company. So, the financial manager is responsible to find an optimal point in the company. There are three cases of optimal point that we can see in the company. For the first case, there will be no optimal point included in the company. This is because the company has no corporate taxes or bankruptcy costs. Based on Modigliani and Miller theory, this case is a symmetry information. It means the information that the company has is same with the information that investor have. For the second case, there will be an optimal point that fully depends on the debt. This is because the company only have corporate tax but not the bankruptcy cost in the company. So, as you can see in the graph, the first stage of the line is declining. This is because the cost of the debt is cheaper than the cost of equity. Then, the line is start to rising because the cost of debt is rising too. For the last case, the corporate tax and bankruptcy costs are included in the company. So, the optimal point for this case is part of debt and part of equity. In this case, if the debt to equity ratio is increased, the probability of bankruptcy cost will increase too. Besides, the value of weighted average cost of capital will be increased as the value of debt are added in the company.
To determine the factors of capital structure and capital structure decision, there are two perspectives of theory, which are trade-off theory and pecking order theory. For factors affecting capital structure, there are 4 points I attach, which are firm size, tangibility of asset, profitability, and growth opportunities. The first factor is size firm. The small firm may face great difficulty to gain long-term finance. They usually rely on retained earnings and share capital in order to achieve the requirements of long-term funds. From this, we can see that the chances of small firm to fail is higher compared to the large firms. The second factor is tangibility of asset. This is a measurement on how much the collateral of a firm can offer to their debtors. Based on my research, it is compulsory for a firm to have or maintain a high ratio of fixed to total to ensure that they have sufficient liquid assets in case they are facing bankruptcy phase. The third factor is profitability. Usually, the firm's people and analysts will consider the previous performance. The firms with high profitability will use less debt because they have high retained earnings to finance their funding needs. The fourth factor is growth opportunities. Based on trade-off theory, it is predicted that a firm with high investment opportunities would face less leverage. This is because they can avoid conflicts from stockholder and bondholder regards to underinvestment and asset substitution. Next, there are two factors that can affect capital structure decision. The first one is taxes. Firms with sufficient accumulated losses will get little value from interest tax shield. Usually, the firms will try their best to get tax deductibility of interest payment in order to pay tax with a lower amount. Based on trade-off theory, it is predicted that firms will issue more debt when corporate tax rates are higher. The second factor is volatility. Based on my research, it stated that firms with a volatile cash flow would experience higher expected costs of financial distress and agency costs, hence reducing the probability of tax shield will be fully utilized. This will make the firms least preferable and demand a premium to provide them.
Next is financial distress. Financial distress is when a company or individual is unable to generate enough income or revenue to meet or pay its financial obligation. This is because of high fixed costs, a large portion of illiquid assets or revenue that are sensitive to the recessions of the economy. For individuals, financial distress can occur because of poor budgeting, overspending, excessive debt load, a lawsuit, or the loss of employment. For your information, when the company or individual ignore the signs of financial distress, it can lead to bankruptcy or a worse financial condition. Financial distress in a company. Although the company is well managed, they still can get financial distress. A sudden and unexpected recession in the economy can lead to a significant drop in a company's revenue. For example, there were many companies that had previously received consistent and high income for years, but suddenly their revenues dropped rapidly due to the lockdown during the COVID-19 pandemic. Next, improper management is one of the financial distress in a company that is caused by inefficient decision making, which eventually results in a decrease in revenue. Top executive may overextend the company financially by borrowing money to fund growth. If the borrowed money does not lead to increased revenues or profit quickly enough, then the company may begin to struggle to meet its debt payment.
Next, I will talk about integration of tax effect and financial cost distress. Basically, financial distress is when the corporation or individual are incapable to pay the outstanding debts in the company. When the level of debt keep increasing and the value of estimated tax shelter of the debt growth from the debt also keep increasing. However, the value also estimated to losing because of the financial difficulties and also the expenditure keep rising. Furthermore, tax benefit from leverage is clearly applicable for the corporation that is tax-paying position. When the business owner have huge depreciation, so that the interest tax shield will also be less of use. In addition, all of the corporation are facing the same percentage of 21% federal tax rate in earlier of 2018, but different tax rate have different effective. The impressive the tax rate, the significant the value of incentive to carry off.
Next, for agency of cost, it is a cost that used to monitor a company's performance. Who will use or spend on agency costs? It is either shareholders or bondholders. The factors that lead to have this problem are: the company may face difficulty to communicate with their shareholder or bondholder. The second one is management people may take advantage for their own benefits. And the last one is reduce incentive to the company.
Next is pecking order theory. Pecking order theory is related to the capital structure of the company. This theory attempts to explain why firms prefer one type of financing over another. The reason is that when the degree of asymmetric information increases, so the cost of financing also increases. There are many companies prefer to use internal financing rather than bank debt or public equity because these sources of funding are far too expensive. According to the pecking order theory, a company should fully utilize its internal financing until it is exhausted, followed by debt if necessary, and then equity is the final choice of financing method. Under the pecking order theory, internal financing comes directly from the firm and get to reduce the information asymmetry. In contrast, external financing, equity financing or debts require the firm to pay fees to ensure they get external financing. From the comparison, internal financing is more economical and convenient as the source of financing compared to external financing. When a company uses external financing such as equity or debt to fund an investment opportunity, the demand for the return will be higher because investors and creditors have less knowledge about the firm compared to the managers who know more information about the firms. Managers are more prefer debt over equity for external financing because the cost of equity is higher than the cost of debt. The issuance of debt frequently shows the signal that the stock is undervalued and boards believe that the investment will be profitable. In contrast, the issuance of equity shows a bad signal, which is overvalued stock, and leads the management to find a way to generate financing. Therefore, when it comes to financing, the cheapest option is return earning, which is internal financing, followed by debt, and then equity is the last option for financing method.
Last but not least, I will explain about the signaling hypothesis, especially the debt of the firm. Debt signaling can help the investors to make a decision whether they want to enter or to exit the firm. Industry insiders can give the signal within direct or indirect way. They can make an announcement about their new debt, or investors can analyze through their actions. When the company issuing bondholders, it shows that the company have a strong financial and they are ready to grow their business with the new debt. In investor perspective also, they see that they can make profit with the new project because the company are ready to make a new project with their new debt. Most of investors will more attract to invest in company that issuing bondholders rather than company that issuing equity. This is because company that issuing bondholders can give a lot of profit to the investors, while company that issuing equity make the investors lose some their rights in the company. So what I conclude is signaling hypothesis is really important to the investors so that they can make a decision whether they want to enter the market that can give benefits to them or they want to exit the bad market. If there is no signal from the industry insiders, there will be no action from the investors to enter or to exit the market.